Welcome to the deep dive. Today we're going to dig into a major player in consumer staples, Altria Group, ticker MO.
Yeah, we're looking specifically at their third quarter and 9-month performance for 2025.
And we're basing this on their official filings, the 10Q, the earnings announcements, all the raw stuff.
Exactly. Our job here is really to cut through the noise.
Mhm.
Altria's management, they keep saying they're moving beyond smoking, building significant momentum.
Right. So is that actually happening? That's what we want to test.
We'll look at the financials, their big strategic shifts, and obviously the legal and regulatory stuff, which is always huge for them.
Okay, so let's jump right in with those big headline numbers because they tell a confusing story at first glance.
They really do. If you just look at the reported diluted EPS for the 9 months ending September 30th, 2025, well, it looks like a disaster.
Yeah, it dropped massively, down to $3.45 from $4.75 the year before. That's a big fall.
Huge. But, and this is critical, that number is packed with what they call special items, big one-off things. So when you strip those out, you get the adjusted diluted EPS. And that actually went up 5.9% to $4.12.
Okay, wow. So reported is way down, adjusted is nicely up. That's a pretty dramatic difference. What are these special items?
Well, there are two really big ones driving this divergence between 2025 and 2024. In 2025, the big hit was this $873 million non-cash goodwill impairment charge.
Okay, impairment. That means writing something down.
Exactly. It was for their e-vapor unit, NJOY. Basically, they're admitting the acquisition isn't worth what they thought or hoped. It's underperforming.
Got it. And what about the comparison year, 2024? Why was the reported number so high then?
Because in 2024, they had a massive gain. They sold the IQOS commercialization rights back to Philip Morris International. That gave them a huge, like, $2.7 billion pre-tax boost.
Okay. So 2024 had a giant one-time gain. 2025 had a giant one-time loss. Or write-down.
Precisely. So the reported earnings crater, even if the actual day-to-day business, the adjusted stuff, is actually improving slightly.
That really sets the scene. Management's talking momentum, but adjusted ETS up, while, as we'll see, revenues are down. It feels like maybe they're just really good at managing profit on the old stuff, not necessarily growing the new stuff yet.
That's the core tension, I think. So let's look at that core business first, the smokeable segment. It's still the engine, right?
Right. How did that perform?
Well, in terms of profitability, pretty well, actually. For the first 9 months of 2025, the reported operating company's income, OCI, was up 1.9%.
Okay.
And the adjusted OCI, stripping out any quirks, was up 2.5% to $8.341 billion. So profits holding up, even growing a bit.
But didn't you say revenues were down? How does that work? Profit up, revenue down.
The net revenues for smokables over those same 9 months decreased by 3.6%, down to $15.366 billion.
So less money coming in the door overall, but more profit kept.
Exactly. It's the classic tobacco industry playbook, right? Volumes are falling, sometimes steeply, but they keep raising prices.
Aggressive pricing.
Very aggressive. So the higher price per pack more than makes up for selling fewer packs, boosting the profit margin even as total sales dollars drift lower. They're masters at extracting profit from that shrinking base.
Let's talk about those volumes then. How bad was the decline?
It's pretty significant. In the third quarter of 2025 alone, their total domestic cigarette shipment volume fell 8.2%.
8.2%. Ouch. And what about Marlboro, their main brand?
Even worse for Marlboro, actually.
Yeah.
Its shipment volume dropped 11.7% in Q3. That's a really sharp decline for their premium anchor brand.
Why such a big drop? What's driving that?
Well, the company points to a few things. First, just the overall industry decline rate. People are smoking less.
Okay, the secular trend.
Right. Second, they specifically mentioned discretionary income pressures. Basically, inflation hitting smokers' wallets.
Making them maybe trade down from premium, like Marlboro.
Exactly. And third, and this is a recurring theme, the impact of flavored disposable e-vapor products, mostly illicit ones.
Illicit vapes are hitting cigarette sales, too.
Seems like it. They're competing for those nicotine dollars, you know.
And that trading down idea, we see that in the market share data, right? The discount segment.
Oh, absolutely. It's very clear. The total discount cigarette category reached 32.2% retail share in Q3 2025.
32%. Wow. How much is that up?
That's an increase of 2.4 share points just from Q3 2024. That's a fast shift towards cheaper smokes.
So consumers are definitely feeling the pinch and going for value.
No doubt. And Altria's response: keep hiking prices on the premium brands. Marlboro got list price increases in January, April, July.
Right.
And they announced another one for October 2025.
Milking the premium segment while they can.
Pretty much, yeah. which logically leads us to their transition portfolio, the stuff that's supposed to be the future beyond smoking.
Right. Let's start with oral tobacco. The overall segment volume there was actually down 9.6% in Q3 2025. That seems wrong for growth area.
It does sound counterintuitive, but you have to look inside that segment. It's really a tale of two very different products.
Okay.
The decline is entirely driven by the traditional stuff. Moist, smokeless tobacco, MST, think Copenhagen, Skoal. Those brands are falling off a cliff.
How fast?
Well, Skoal volume was down something like 17.1% in Q3. Copenhagen down 12.4%.
Yeah.
The old dip and chew formats are just fading.
Okay, so the legacy oral products are tanking. But what about the modern stuff, the nicotine pouches?
That's where the growth is. Their brand, Unsway, saw its volume jump 14.8% for the first 9 months of 2025.
14.8%. That's solid growth.
It is, and it reflects the broader market shift. The nicotine pouch category itself now makes up 55.7% of the entire U.S. oral tobacco space.
55%, so pouches are now the majority.
Yep, gained over 11 share points in just 1 year. The market's clearly moved towards pouches, and Altria's on. Brand is capturing a good chunk of that.
And they seem to be pushing hard on the regulatory side for On, too. We saw something about On T-Cell US launching without a full FDA order.
Yeah, that's interesting. They started selling On PLUS in October 2025. The FDA's 180-day review period expired, and even though they didn't get a formal marketing granted order, an MGO,
They launched anyway.
they did. It's being reviewed under a new FDA pilot program that's supposed to streamline these reviews for pouches. So Altria is definitely pushing the boundaries there, trying to get product out fast while the category's hot.
Trying to get ahead of the slow FDA process.
Seems like it. Now, contrast that relative success in oral with the headache that is e-vapor,
Yeah.
NJY.
Yeah, that $873 million impairment charge we mentioned earlier, that doesn't exactly scream success.
No, it's a huge red flag. It's
Yeah.
basically an admission that the NJOY acquisition is in trouble. And a big reason is they're fighting an impossible battle, really,
Against what?
against the illicit market. The report estimates that flavored disposable e-vapor products, mostly illegal imports, make up more than 60% of the entire e-vapor category.
60%. So the majority of the vape market is illegal stuff.
That's the estimate, yeah. How can a legal product like NJY's ACE possibly compete with that flood of cheap flavored, unregulated stuff?
Especially when, isn't there a legal issue with NJY ACE itself?
Yes. On top of the illicit market problem, their main FDA-authorized product, the NJY ACE, is currently blocked
Blocked how?
by the International Trade Commission, the ITC. They issued an exclusion order and cease and desist orders back in March 2025.
Why?
Patent infringement. They found NJY infringed on someone else's patents. So ACE can't be imported or sold in the U.S. right now.
So their one FDA-approved vape product, they can't even sell it.
Pretty much. They're appealing the ITC decision, of course, but for now, their key legal product is sidelined. It's a mess.
Wow, so massive illicit competition, and their legal alternative is tied up in court.
Exactly. They're trying to fight back on the legal front, though. Besides appealing the ITC ruling against them, they're also trying to revive their own patent lawsuit against JULL in Delaware. So lots of expensive legal battling all around in e-vapor.
It sounds like a really tough spot for their moving beyond smoking plan in the vape category.
It absolutely is. Which brings us nicely to the broader regulatory and litigation landscape.
Yeah.
Section 3. This is just a constant factor for Altria.
Yeah, the legal uncertainty seems permanent.
It really is baked into the cake for them.
Yeah.
They always state in their filings that lawsuits could, materially affect their results. It's a constant risk.
And some old battles are still being fought, like the Engle cases in Florida.
That's right. As of late October 2025, there were still about 51 of those Engle progeny cases pending. These are tricky because the plaintiffs get a head start. The courts already found smoking causes disease, nicotine is addictive, etc.
Makes it easier for them to win damages.
Potentially, yes. However, there was some good news on the litigation front recently, internationally.
Oh, what was that?
In Canada, there was this massive CAD $32.5 billion settlement plan involving several tobacco companies that was finalized in August 2025.
Okay. How did that help Altria?
Because of old agreements they had with Philip Morris International, PMI. Basically, PMI indemnified Altria and its subsidiary PM USA. So when this Canadian settlement happened, Altria got released from liability without having to pay into that massive fund.
So they dodged a multi-billion-dollar bullet there thanks to PMI.
Essentially, yes. A huge potential liability just vanished. But they still carry ongoing litigation costs. The accrued liability for tobacco and health lawsuits was about $68 million at the end of Q3.
It's always something. And then there's the FDA looming large.
Always. The biggest potential threat is still that proposed rule to drastically cut nicotine levels in cigarettes, making them minimally or non-addictive.
If that ever happened.
It would fundamentally change their core business overnight. It's a huge, huge risk hanging out there.
And what about flavor bans, menthol, etc.?
Well, the proposed federal bans on menthol cigarettes and flavored cigars got kicked back to the FDA in January 2025. So limbo on the federal level for now.
But states aren't waiting, are they?
No, not at all. 6 states, California, Massachusetts, New Jersey, New York, Rhode Island, Utah, plus Washington, D.C., they already passed their own bans on flavored tobacco products.
That creates a real patchwork for them to navigate.
Absolutely, and it restricts where they can even sell some of these new alternative products.
And we can't forget taxes, always going up.
Yep, the average state cigarette tax is now over $2 a pack, $2.01. And crucially, states are increasingly targeting the alternatives too.
Taxing vapes and pouches.
Oh yeah, 34 states now tax e-vapor products and 18 tax oral nicotine pouches.
Which kind of undermines the switching argument, doesn't it? If the alternatives aren't much cheaper.
It absolutely does. It makes it harder financially for consumers to move away from cigarettes, which seems counterproductive if public health is the goal.
Okay, let's shift to Section 4, Capital Allocation Financial Health. Despite all these headwinds and legal costs, they seem very committed to shareholder returns.
Utterly committed. It's priority number 1, clearly. They announced another dividend increase in August 2025, up 3.9%.
How many increases is that now?
That was the 60th increase in 56 years. The current annual rate is $4.24 per share. That dividend growth is sacrosanct.
And they're buying back shares too.
Yes, they expanded their share repurchase program in October, added another $1 billion to it, making it a $2 billion program running through the end of 2026.
So management clearly thinks the stock is a good buy and they're returning cash aggressively.
Definitely signaling confidence, and it also helps boost that adjusted EPS number we talked about earlier. Fewer shares means higher earnings per share.
But are they taking on too much debt to fund all this? How's the balance sheet look?
Actually, it looks pretty solid. Long-term debt did tick up a bit to $25.7 billion, but their key metric, debt to EBITDA, is only 2.0.
And what's the limit on that?
Their loan agreements require them to stay below 4.0.
Yeah.
So 2.0 is very comfortable. They have plenty of financial breathing room.
Which they need, given those massive annual payments they have to make, right? The settlement stuff.
Exactly. Those payments are non-negotiable. The estimated annual cost just for the state settlement agreements and the FDA user fees is around $3.0 billion per year for the next few years.
$3 billion just walking out the door every year before anything else.
Right. Before dividends, before buybacks, before investing in NJJY or on. That's a huge cash hurdle they have to clear every single year.
Okay, so let's try to wrap this all up. Synthesize what we've learned. It really feels like Altria is living in two different realities right now.
I think that's a good way to put it. On one side, you have this impressive operational discipline of a core smokeable business. They use that pricing power to keep adjusted EPS growing, keep funding those massive dividends and buybacks. Real resilience there.
But on the other side, huge challenges. The core cigarette volumes, especially premium, are falling fast. The big bet on e-vapor, NJOY, is clearly struggling, marked by that huge write-down.
And then you have the external pressures. The constant regulatory threats, the state flavor bans, the tax hikes, and maybe biggest of all, that enormous illicit e-vapor market that just operates outside all the rules.
The on pouches show they can transition successfully in a category.
Right. When the conditions are right, on pouch proves the model works. But the NJY situation shows just how difficult it is when you're facing, 60% illicit competition and your main legal product gets blocked by patent disputes. Scaling those new categories is incredibly hard.
Which leads us to maybe the final provocative thought for our listeners.
Yeah.
It seems like the whole success of their moving beyond smoking strategy hinges on this fundamental mismatch in speed. You've got the FDA, which moves incredibly slowly on authorizing legal alternatives like NJY-ACE or on
Slow sometimes.
And then you've got the illicit market, especially for vapes, moving at lightning speed, unregulated flavored products flooding in. How can Altria possibly bridge that gap?
That's the billion-dollar question, isn't it? How do you execute a legal regulated transition when the illegal market is faster, cheaper, and offers more variety? completely unchecked.
Until that regulatory dynamic changes or enforcement against illicit products gets way more serious, it feels like their strategy is constantly swimming upstream.
It really does. That gap between the speed of the regulator and the speed of the illicit market. That might be the single biggest obstacle to Altria truly moving beyond smoking.
Something for you all to think about. That's all the time we have for this deep dive. Thanks for joining us.
We'll catch you on the next one.